Hey guys, welcome back to the channel. Today I wanted to go over tax-advantaged accounts. So first off, just talking about tax-advantaged accounts, the goal of tax incentives for the government is to get individual people to do certain things. And because of that, they want to incentivize people to save money for certain events. These tax-advantaged accounts will also come with restrictions, right? So if you're not using them for the intended purposes, there are going to be penalties for them. And that's one thing to consider when you're looking at any of these tax-advantaged accounts. Now, to get started, I just wanted to talk about the two types of tax-advantaged accounts. There are tax-deferred accounts and there are tax-exempt accounts. And the majority of these are going to be tax deferred in some way, but there are a couple that are tax exempt. And so you'll just want to know that a tax deferred account just means that you're going to pay the taxes at a different time. Whereas a tax exempt account means that you're basically just going to be exempt from taxes. You won't even have to pay them. Let's start with the big bucket, which is retirement accounts. Now, the government really wants to incentivize individuals to save for their retirement. So, when you stop working at 65 or whenever you decide to retire, you're gonna need a good amount of money to continue living through the rest of your life without income. With the fall of traditional pension plans and, Social Security, the government really wanted to privatize how we were saving for our retirement. So they built in a lot of incentives to start investing in your retirement accounts. So to get started, let's talk about the 401k plan. Now, this is an employer-sponsored retirement plan that allows employees to contribute a portion of their pre-tax salary. So basically, when you're working a job, a company can have a 401k plan. And basically what it says is that before you pay taxes, you can pull money out and place it inside a 401k. Now, a lot of employers will actually match funds, and they do this in different ways. But some employers will match 100% of how much you put in up to a certain amount. Other employers will match 25%, 50%, various amounts. But basically what you're doing is you're putting in all your money before you have to pay taxes. So that money that would have originally gone to taxes will actually work for you over the years. Now, eventually you will have to pay those taxes when you pull it out, but you'll have used that time to compound the money you wouldn't have had otherwise. Now, there are limits to how much you can put into your 401k each year, and for 2025, that limit is $23,500. What I will say about what's great about 401ks, and especially the matching program, is that it's basically free money that you get from your employer. So my recommendation is always to put at least as much as your company is willing to match. That's not always possible for everyone, but as much as you can, it's really great not to say no to free money. Now, the 401k, like other retirement plans, will have penalties for any money that you withdraw early. And that penalty is 10% if you withdraw money before you turn 59 and a half. Now, one other thing to note about these retirement plans is that you will have to start taking what's called required minimum distributions at the age of 72. So this just means that at some point, the government expects you to withdraw money from your account, and there's a minimum amount that you have to withdraw. That just means, the government is not going to let you keep that money tax-free forever. They're going to start to have you draw it down, and then you'll have to pay taxes on that. So yeah, your 401k is a retirement plan that is supported by your employer. Now, not everyone has a 401k plan that their employer offers. So in those situations, we're going to go over two other plans, the traditional IRA and the Roth IRA, an individual retirement account. And contributions are, again, tax deferred here, just like the 401k. And like a 401k, you're putting in pre-tax money. So the money will be taxed when you withdraw it later on when you retire. So basically, a lot of the same rules apply from the 401k, except, you're not going to be getting an employer match because it's not sponsored by an employer. You'll also have to adhere to the restrictions of when you can pull money out and the required minimum distributions as well. Similar to the 401k, you'll also be penalized 10% if you withdraw early. One thing to note is that with the IRA, your contribution limit is a lot lower than your 401k. You're only allowed to contribute $7,000 if you're under 50 and $8,000 if you're 50 years or older. All the same rules basically apply from the 401k to the IRA. And from the IRA we'll move on to what's called the Roth IRA. So similar to the IRA, all of your investments grow over time without taxes. But instead of getting taxed at the end of the period when you retire, you're actually putting in post-tax money. So you won't be taxed at the end because you'll have already paid those taxes. And so the Roth IRA has the same contribution limit as your IRA. In fact, you have to allocate that $7,000 between your Roth and your IRA. So in total, between your Roth and your traditional IRA, you're allowed to contribute $7,000. The last retirement account I'll talk about is probably not for everyone. It's only for people who are self-employed or have a small business. It's called the SEP IRA, which is a Simplified Employee Pension IRA. And it's a retirement plan designed for small businesses and self-employed individuals. So the IRS says that contributions an employer can make to an employee's SEP IRA cannot exceed the lesser of either 25% of the employee's compensation or $69,000 for 2024. So it is a much higher contribution limit than even the 401k and definitely the IRA and the Roth IRA, but it also is tied to the employee's compensation. Now, all the similar penalties apply with the SEP IRA. Again, you can't pull money out before you're 59 and a half without paying 10%, and you will be required to make required minimum distributions or RMDs after the age of 72. So when you want to put money into basically a 401k, a traditional IRA, or a SEP IRA, or a Roth IRA. So basically, the consideration to make is, are you going to be making more money now or later? Because what you want to consider is how much you'll be paying in taxes. If you're going to be a high income earner right now, but later on expect that you won't be making a lot of money from your retirement accounts or properties that you own or any capital that you've bought, you probably want to put money into tax-deferred accounts. So basically, you probably want to start maxing out your Roth IRA first and then move to your IRAs and your 401ks. Like I said, you want to prioritize getting free money from your employer, so that should be a top priority first. But for most of us, we're probably going to be higher income earners at the time of our employee contribution than we will in the future. Because in our retirement, we probably won't have a job that gives us income. We'll only be living off of Social Security payments, purchases of capital that we are creating income for us, any sort of passive income that we've acquired. So if you have properties that you lease out, and then any sort of money that you make from your investments. One other thing to note about the 10% penalty is that they only apply to money made above your contributions. So you're actually allowed to pull out initial contributions that you've made without incurring that penalty. All right, next up, I'm going to talk about the 529 plan. Now, this is a plan that the government created in order to incentivize people to save for education. 529 plans are state-sponsored plans that allow you to save for future education expenses. Unlike the retirement accounts, there's no penalty for when you take it out, but there is a penalty if you're going to use the money for something other than education. So with 529 plans, there are actually no contribution limits in any given year. But something to note is that if you're opening the account for someone else, there are gift limits that you're not allowed to exceed without having to pay additional taxes. In 2025, that gift limit is $19,000. So that's one thing to note. Now, another cool benefit of the 529 plan is that it doesn't have to be used by the person who it's assigned to. As long as it's used for approved educational costs, you can use it for anyone. You can also use it to repay student loans up to $10,000. Now, 529 plans vary by state, so you'll have to check where you live. The next two accounts I'm going to talk about are both related to health. So there's the health savings account, and then there's the flexible spending account. So that's HSAs and FSAs. Now, for 2025, the maximum HSA contribution is $4,300 for an individual and $8,550 for a family. And what you have to note is that, like the educational plan, you have to use this for medical-related expenses. Now, in order to contribute to an HSA, you do have to have a qualifying high-deductible health plan. And there's rules within the IRS that state whether your plan meets those qualifications. The HSA can be used for a whole host of things, including deductibles, co-pays, co-insurance, medications. The great thing about the HSA is that you can continue to appreciate over time and you don't have to use that money in any given year. Unlike the HSA, the flexible spending account, or the FSA, you have to use within the calendar period. Now, the limit for contributions for the FSA are $3,300 per year per employee. You can roll over some amount, which is $660 for 2025, but employers can set different limits for them. Okay, so we've gone over some common tax-advantaged accounts, including retirement accounts, an education account, and two options for healthcare accounts. The last thing I'm going to talk about is not an actual account, but a security that offers some tax advantages. And so what we'll be talking about are municipal bonds, otherwise known as muni bonds. Now, municipal bonds are bonds issued either by the state or by local governments, basically to finance any sort of thing that the government wants to purchase, right? So roads, libraries, any public infrastructure. So when the government wants to pay for something, they want to issue bonds. And so in order to get people more interested in purchasing these bonds over other bonds, a lot of these states or counties or cities will allow them to be tax-free. It's really important that you know where you're filing your taxes so that you can, if you're paying state taxes in California, for instance, you want to make sure you're buying California municipal bonds. And if you're paying like a local Los Angeles tax, then you want to make sure that you're buying Los Angeles municipal bonds to increase the tax advantage to your accounts. But municipal bonds are a great way to have regular income, just like regular fixed income, but also save money with taxes. So like all things on these accounts, the one thing you should note is, right, they come with their own limits and sort of penalties. So while the government offers you tax incentives to invest in them, they're also going to penalize you for not using them in the way that they want you to. As a rule of thumb, I also wanted to offer this last piece of advice. The general rule is to place higher earning assets into tax-deferred or tax-exempt accounts. That means anything that's producing a lot of interest that would be taxed at income should go in a tax-exempt account. Whereas anything that could grow a lot but doesn't produce income should go in your regular taxable account. So basically, an example of that would be any sort of high yield interest bonds should go into your tax-deferred or tax-exempt accounts first. That just means that you're not going to be paying money on the interest that you earn there. And then an example of something that could go into your regular taxable account is something that might grow a lot over time, but doesn't pay a dividend or an interest. And that's just sort of like a general rule to note as you're sort of deciding where to place securities. Well, I hope you found this video helpful. I know there are a lot of tax-deferred and tax-exempt accounts out there, but hopefully this gave you an overview of what options you have.